Good evening, everyone. Welcome to the channel. Before I begin, here are my disclaimers. Today I am going to give you an update about Sinopec Kantons Holdings Limited latest report. Sinopec Kantons Holdings Limited is an investment holding company that provides various businesses and services to the oil and gas industry. The company's primary operations are divided into two main segments: crude oil jetty and storage services, and vessel chartering and logistics services. In the crude oil jetty and storage services segment, Sinopec Kantons Holdings Limited offers a range of services including crude oil transportation, unloading, storage, and other jetty services for oil tankers in China, Europe, and the Middle East. This includes providing facilities for oil tankers to dock and unload their cargo. The company also provides vessel chartering services for liquefied natural gas, LNG, transportation in China, Australia, and Papua New Guinea. This involves chartering vessels to transport LNG from one location to another. In addition to its core operations, Sinopec Kantons Holdings Limited engages in the trading of crude oil and provides oil supporting and ancillary services. These services are designed to support the oil and gas industry by providing essential infrastructure and logistics for the transportation and storage of crude oil and other petroleum products. Overall, Sinopec Kantons Holdings Limited plays a critical role in the global oil and gas industry by providing a range of businesses and services that enable the safe and efficient transportation and storage of crude oil and LNG. Sinopec Kantons Holdings Limited market capitalization of $11 billion is significantly larger than the average industry peer of roughly $0 billion. This shows that Sinopec Kantons Holdings Limited holds a significant advantage in their industry. Sinopec Kantons Holdings Limited trades at a lower price-to-earnings ratio of 10 times and a lower price-to-book ratio of 0.65 times relative within the industry. This suggests a potential market detachment, as Sinopec Kantons Holdings Limited trades at discounted levels while the broader industry remains fairly valued, warranting deeper fundamental analysis. The balance sheet appears very conservative, with liabilities representing only 2% of total assets. While this indicates low financial risk, investors should examine the composition and quality of the company assets to determine whether they justify the current valuation. Average liabilities have declined over the past 5 years, indicating improving balance sheet discipline and reduced financial risk. Shareholder equity has grown consistently, but operating income growth is weak or inconsistent. Equity expansion may be driven by financing activities rather than core business profitability. The share count has remained broadly unchanged, indicating no significant dilution or buyback activity over the past 5 years. The company have a dividend yield of 5.84%. The income statement shows that the company revenue have been declining annually and operating income have not been increasing. This shows that the business is under pressure with rising cost and its management is unable to expand the business. The primary drivers of revenue growth or decline in various business segments are multifaceted. On one hand, the crude oil jetty segment has experienced a significant surge in revenue, increasing by 100% without any comparable data from previous years. Additionally, the naphtha unloading business has seen a notable year-on-year increase of 6.75%. Conversely, some segments have witnessed declines in revenue, including the crude oil unloading business at KFAD and Shihua and 5 domestic terminal companies, with decreases of 3.63% and 14.24%, respectively. The overseas storage business has also experienced mixed results, with a 7.35% increase in throughput in the Netherlands, but a decline in occupancy rates in certain quarters. The provision of crude oil jetty services saw a modest 0.5% increase in revenue. However, the decline in revenue from Sinopec Group customers, from 89% to 83%, is a notable concern. The overall year-on-year decrease of approximately 1.27% in revenue highlights the need for a comprehensive analysis of these trends and drivers to inform business decisions. The net income of the company experienced a mixed trend across different segments in 2024 compared to 2023. The crude oil jetty segment saw an increase of $176,691, while the logistics services segment's net income rose by $527,623. However, the total net income only increased by a relatively small amount of $177,400. The profit margins also underwent changes in various segments. Notably, the crude oil jetty segment's profit margin decreased from 41.8% to 41.1%, while the refinery's profit margins improved significantly from -10.88% to -7.32%. The introduction of a new chartering and services segment reported a profit margin of 10.1%. In contrast, the logistics services segment maintained a high profit margin of 50.3%. These changes in net income and profit margins suggest that the company's performance varied across different business segments in 2024. The company's financial performance indicates a concerning trend in its ability to generate positive operating cash flow. The net cash outflow of $51,056, page 4, and the negative net operating cash inflow of $1,444,000, page 10, are clear indicators of this issue. Furthermore, the operating cash flow status is explicitly stated as negative on page 18. These figures collectively suggest that the company is struggling to generate sufficient cash from its operations, which could have significant implications for its long-term sustainability and growth prospects. The performance of various segments and regions in the industry has been mixed. On the negative side, the vessel and storage segment, chartering and services segment, and logistics services segment have all underperformed. The overseas storage business also saw a decline in occupancy rates and throughput in some areas, such as Vesta, Belgium, where throughput fell by 2.36%. However, there were some bright spots within this segment, with Vesta, Netherlands, experiencing an increase of 7.35% in throughput. In contrast, the crude oil jetty segment has been a standout performer, with segment results showing significant growth. This is a notable exception to the overall trend of underperformance in other areas. Overall, while some segments and regions have struggled, others have shown resilience and even growth, highlighting the complexity and variability of industry performance. Management is expressing a positive outlook for the company, highlighting several key initiatives aimed at improving performance. Firstly, they are strengthening internal controls and supervision of critical areas, demonstrating a commitment to accountability and transparency. In addition, management is enhancing their compliance risk management system, which suggests that they are proactively addressing potential risks and ensuring adherence to regulatory requirements. This move not only mitigates potential liabilities, but also fosters a culture of compliance within the organization. Furthermore, management is focusing on optimizing funds management, with the goal of achieving higher interest rates on deposits and extending deposit periods. This strategy indicates a desire to maximize returns while maintaining customer satisfaction, underscoring the company's focus on financial performance and growth. The company has a history of paying dividends to its shareholders. In fact, it has explicitly stated that it has paid dividends. This is further supported by specific financial data provided on page 18, where an interim dividend of $148,616,000 and a proposed final dividend of $372,924,000 for the year 2025 are mentioned. The company's dividend policy is clearly outlined in the provided information. On page 20, it is stated that the interim dividend for 2025 will be 10 cents per share, while the final dividend, excluding the interim dividend, will be 25 cents per share. This demonstrates a clear commitment to rewarding shareholders through regular dividend payments. The confirmation of dividend payments on pages 21 and 29 further reinforces this conclusion. It is evident that the company has a track record of paying dividends and intends to continue doing so in the future, as indicated by its proposed dividend payments for 2025. Concerns about inventory buildup or supply chain disruption are emerging due to a decline in various key indicators. The unloading volume of crude oil from Sinopec Group has decreased by 10.88%, while the throughput of crude oil at domestic terminal companies has dropped by 14.24%. This suggests potential disruptions in the supply chain. Furthermore, overseas storage business throughput and LNG transportation and logistics metrics have also seen a decline, with decreases ranging from -2.6% to -5.44%. These drops indicate that there may be issues with inventory management and supply chain efficiency, which could lead to future problems if not addressed. That concludes the financial summary for Sinopec Kantons Holdings Limited. Feel free to comment below, and I will be happy to answer them when possible.